The S&P 500 is creating quite a bit of optimism in the market, and that outweighs the concerns surrounding the Middle East issues. At its interim earnings report, 61% of the 500 companies have reported. This is based on last day of July. 86% of these companies have earnings that beat estimates. Quite a decent number. And the blended earnings growth figure is 47.4% year-on-year. That's the combined actual reported results with estimated projections for companies that haven't reported. This is the strongest number since Q2 of 2021. But it's because of outliers. Alphabet's and Amazon's Q2 2026 earnings came in very high because of unrealized gains in equity securities. The exceptionally high earnings didn't come from their core businesses. It's because Alphabet and Amazon own large stakes in other tech companies. And those tech companies recently had sharp gains. And because of accounting rules, these need to be factored in. To smoothen out this outlier data, when excluding Alphabet and Amazon, the interim earnings growth will still be a strong 28.8%. 10 out of 11 sectors have year-on-year earnings growth, and 8 of them are reporting double-digit growth. The top 3 are energy, communication services, and consumer discretionary, with tech at number 4 this time around, and the only loser this time around is healthcare. Let's look at revenue. 77% of the 61% of the companies that reported beat estimates, and the blended figure is 14.1% year-on-year, and that's a strong number for revenue. All 11 sectors are reporting year-on-year revenue growth, and 5 are reporting double-digit growth. And no surprise, tech is number 1 in terms of revenue growth, followed by energy and communication services. On to Europe's Stoxx 600. Around 54% of the 600 companies have reported, and this is based on last day of July. 51% of these companies are beating estimates for earnings, and overall, it's relatively broad-based rather than being driven by a few large cap companies like the U.S. market. And quite similar, energy is the main earnings growth driver. Tech and financials are delivering more consistent beats. In terms of growth, 10 out of the 11 sectors are reporting year-on-year growth, and 7 of them are reporting double-digit growth. Top 3 are energy, basic materials, and then technology. The energy industry benefited from mostly being boosted by the high energy prices and with a demand that's still more or less sustaining. And then, the loser is consumer discretionary. We'd covered that Eurozone consumers are cutting down their spendings because high energy prices have reduced their disposable income, and they're also being more cautious and saving more than spending. For revenue, 74% are beating estimates, and the strong ones are energy and technology. 8 out of 11 sectors are reporting year-on-year growth, and only 2 are reporting double-digit growth. Top 3 are energy, then technology, then industrials. The losers are consumer discretionary, flat, there's no gain. Consumer staples, obviously, will face a decline, and followed by telecommunications. The U.S. unexpectedly lost 23,000 jobs in July. The trend is at the chart on the right. Quite a bit of a sharp fall from the positive trend in previous months. Unemployment rate eased to 4.1%, previously at 4.2%. But this is mainly because fewer people are participating in labor force. Wage growth slowed to 3.2%, and this will help a little with inflation pressure. So, the market read this report as bad news for jobs, but good news for the probability of interest rate hike, which is lower now. Stocks and bonds did fairly well, and the dollar fell a little. Let's cover the background on jobs. The main reason for the overall decline is because of the government education segment, which saw a huge drop of 50,000. Retail trade also dropped at 19,000. Financial activities also dropped at 14,000. Healthcare, as usual, remained positive, and this time around, construction came in stronger. On to unemployment. Even though the headline figure dropped, it can be misleading because the calculation unemployment only counts people who have no job and are actively looking. It excludes those who have given up. Looking at the labor force participation rate, it dropped to 61.4%, with 264,000 people who left the labor force. That's a huge amount of people who decided to give up. The key point is fewer people were officially classified as unemployed. But on to the bigger picture, the loss of momentum in jobs for July is supporting the interest rate hold. But ultimately, Fed will still look at September's inflation figure first. After everything, the probability of rate hike fell to around 40%. For impact on the market, U.S. and global stock indexes rallied because of falling rate hike expectations, and tech and consumer discretionary sectors led the gains. Lower rates will support valuation and financing for corporate and loans for consumers. U.S. Treasury fell a little because of the reduced expectations of rate hike. Money markets also pulled back, and the dollar weakened. Now gold is back in the picture, with bullion up around 2%, because inflation seems to be painting a more tapered outlook, and the drop in U.S. dollar brought a better entry point for bullion. On to China, July's export jumped 23.9% year-on-year. Trade surplus is still at a very healthy figure of $112.5 billion. Global demand for AI tech and also pre-tariff shipping front-loading are helping China's strong exports. However, rising trade tensions and the weak domestic demand still present risk. Some background on exports. AI-linked demand is the main driver. High-tech product exports rose 40.7% year-on-year. Mechanical and electrical goods are made up of 60% of January to July shipments, and in late July this year, U.S. replaced the 10% tariffs with a new 12.5%. So, shippers rush to front-load, which allows China to benefit from exports. On to China's July inflation. Both consumer and producers' figures dropped because global oil prices retreated and domestic demand is still weak. The headline consumer prices increased 0.5% year-on-year. It was 1% back in June and is hovering around 1% before that. The trend at the right. And when looking at a core consumer prices, without food and energy, the figure is higher, at 0.9%. This is considered as a good picture. China doesn't want deflation. When you remove food and energy price, you're pretty much looking at services prices, and it's still sustaining at a healthy figure. Producer prices dropped to 3.5% year-on-year, mainly also because of the decline of oil prices and weak domestic demand. China's economic recovery remains unbalanced, with having strong external trade but offset by weak domestic consumption. Household spending is still restrained by property sector downturn and weak job security. That means for downstream consumer goods, they're still faced by price wars and discounting. For impact on market, Chinese blue chips fell a little because the weaker inflation reinforced concerns over domestic demand. Consumer goods and retail will be negative. Real estate is still not doing well. The good one is tech and AI-related ones because of the strong global demand. For bonds, government bonds will be positive because the softer inflation data will increase expectations for monetary easing. Existing government bonds with higher fixed coupons will see prices being supported. For currency, because of increased prospects and interest rate cuts, that will push the currency downwards a little. On to Japan. Household spending declined is the 7th consecutive month year-on-year. The latest number is for June, which fell 3.3% year-on-year. This is much worse than the 1% gain estimation. Consumption remains weak despite improving real wages. People are saving more. Some background for the key reasons are rising living costs. That costs households to save more income. And then Middle East. Japan imports quite a lot of energy, so they're quite affected by the higher energy prices. But a good point is the prices are no longer as high as at the peak of the Middle East war. And then, Japan is facing weather problems, cooler weather, heavy rainfall, and typhoons. People tend to stay at home instead of dining and shopping out. So then, solid growth in private consumption will be very difficult going forward. Lastly, the next Bank of Japan meeting is on September 17th to 18th, and investors are looking for decisions on interest rate. For impact on the market, quite similar to China having weak consumer demand, this will undermine across consumer-facing sectors. Weak consumption will reduce pressure for Bank of Japan in increasing interest rates. This will support Japan government bonds prices. For corporate bonds, because expectations on interest rate hike are more managed now, this will reduce corporate financing cost. And lastly, with still a very low interest rate in Japan, the wide interest rate gap between stronger major currencies will continue to push Japanese yen downwards. Let's try to link today's topic to the market. This is not a buying guide. It's meant to see global market trends. Changxin Memory Technologies came up again. Its shares picked up quite a fair bit, which echoes investors' heavy appetite for semiconductors and AI-driven memory demand. And also, China's high-tech exports rose 40.7% year-on-year in January to July. And then next, Palantir. This is linked to the Interim S&P report. For tech industry, earnings grew 69.4%, revenue grew 35.6%. Palantir's shares rise because it raised its annual revenue forecast. Next, B2 Gold Corp. The U.S. payrolls decline muted interest rate hike probability. The entire gold-related sector gained roughly 20% over the week, and B2Go sat at the top of the move. Lastly, Kingspan Group, which is materials and data center infrastructure, echoing Stoxx interim report. Industrial sectors earnings grew 16% and revenue grew 8%. Kingspan became the top Stoxx 600 gainer after raising its full-year profit forecast because of data center construction global demand.